Good afternoon. Accounting 230 students, we're going into chapter 11. We may be a little bit ahead of the curriculum now, but that's okay. And this chapter is about stock, how to issue stock, how to record stock issues and stock splits and stock dividends and treasury stock. The prior chapter was about companies that raised money with debt. They issued bonds. In other words, they borrowed money from the public with the intention of paying it back, say, in 10 years while making interim interest payments. And there are some advantages to debt financing like that we discussed. You're not giving away ownership of the company at all. You're not diluting your ownership. Tax, at least the interest expense payments are tax deductible, and you retain control. With equity financing, which is what this is all about, we're going to issue stock to the public. When stock is purchased, you own a piece of the company. Thus, any stock issue dilutes your own ownership voting power. So let's get into this, and let me make sure I remember to share the screen. Okay. All right. Corporate reporting and analysis, characteristics of a corporation. These are things you probably know pretty well from your intro to business classes and some of the other work we've done in 110 and a little bit in this course. Corporate form of organization. It's an entity created by the law, and its existence is totally separate from the owners and it has rights and privileges. The Supreme Court has recently ruled basically that a corporation is a person with all kinds of rights. Ownership can be privately held or publicly held. If it's publicly held, then they are required to be listed on the stock exchange only if they provide the right financial information, give out all kinds of reports about what the company is up to, provide audited financial statements to be looked at by those who are interested. Publicly held, it's owned by you and me, the public. We went out and bought shares in this company. I own stock in Coca-Cola. I drink this stuff too much. I own, like I say, 100 shares. My 100 shares allow me to vote those shares. I can attend stockholders' meetings. I have different rights. Of course, my voting power is like one grain of sand in the ocean, just a tiny, tiny ownership. Privately held, you can do whatever, pretty much whatever you want in terms of running the company. You don't have to give out information to the public at all if you don't want to. And some companies prefer to be privately held. Once in a while, you read an article in the business section of the paper, or even on the front page, about a big company that wants to go private, which means they have to buy out all of the outstanding shares at great cost. Characteristics of a corporation, like we said, it's a separate legal entity, limited liability, huh? If you own shares of stock, if you own $1 million worth of Coca-Cola stock, and let's say that Coca-Cola went out of business for some reason, and they rang up debts way up there in the billions, you as a shareholder are only going to lose your original investment. It's not like a partnership or a sole proprietorship where you can be attacked personally. You buy one share of Coca-Cola for $50 and the company goes out of business, that's all you're going to lose, the 50. And the ownership rights are easily transferable. You can do it with the click of a mouse, with a phone call to a stockbroker. Corporations have a permanent, continuous life, huh? No mutual agency for stockholders, easier capital accumulation. These are the advantages. The disadvantages are you got to have a lot of government regulation. Like I say, to be listed on the New York Stock Exchange, you have to jump through many hoops, and keep jumping through those hoops as long as you're listed. And then there's corporate taxation. And this is, I guess, pretty typical, huh? The governance of a corporation. The stockholders are the owners. You and I are the owners of this company. We vote for the membership on the board of directors. The board of directors. The board of directors is typically people from inside and outside the corporation who oversee and monitor what's going on. The board of directors has certain powers. The board of directors are the ones who approve dividends. They hire the corporate officers, and then the corporate officers, of course, manage the employees of the corporation. And we just talked about some of the rights of stockholders. You get to vote at the meetings, sell stock, purchase additional shares if you want. If there's any dividends, you'll get your dividends. And if the company went out of business, you will share in any of the assets remaining after creditors are satisfied. In other words, you own $1,000 worth of stock in a company and they went out of business. After the company that went out of business paid their bankers and the secured lenders, whatever's left over will be split up for the common shareholders. And you might get $10 back on your 50, just as an example. Look at this. A stock certificate in the Green Bay Packers, huh? The Green Bay Packers. By the way, the Green Bay Packers are the only team in the NFL that's actually owned by the public, public stock issue. These stockholders don't have almost no rights. They're not allowed to vote or anything. They just get the pride of being an owner of the Green Bay Packers. And this kind of financing is why Green Bay, which is a small city, can support a National Football League team. Each unit of ownership is a share of stock. And in the old days, you'd get a stock certificate. I remember where I worked for many years, I used to get a bonus at my level. Not that I was that high up on the level, but I'd get maybe 30 shares of Thomas and Betts stock, common stock. And in those days, you would actually get the stock certificate. The paperwork would come in the mail, and you'd have to hang on to this, put it in a safety deposit box. Don't lose it. They're going to cause a lot of problem. And here it says you are an owner of so many shares of the Green Bay Packers. I wonder where Aaron Rodgers is going to play, huh? The New York Jets are talking to him, which I think would be a disaster for the Jets. But I digress. Basics of capital stock. Authorized, issued, and outstanding. Okay, let's start to understand this because now we're getting into some accounting work, huh? Authorized, issued, and outstanding. The authorized shares represent the total amount of shares a company is allowed to sell to the public. The state will decide how many shares you can offer to the public. You may announce that you're going to issue 10 million shares, and the state may say, no good. You can only issue, say, 1 million. So the authorized shares represent the whole pot of shares that can be sold. The issued shares are those that have been sold. Pretty simple, huh? Issued means sold. The outstanding shares are the shares owned by the public. When those authorized shares are issued to the public or purchased by the public now is the owner of this corporation to the extent of the value of their shares. And those are called the outstanding shares, okay? The amount held by the public. Issued, total amount of stock that has been issued or raised, authorized, what they can sell. Here, this company can sell 250 million shares, and they've sold maybe 1/3 of it because the shares outstanding are only 92 million. So they have a lot left they can still issue. And the outstanding shares are what's owned by the public. Par value versus market price. One has nothing to do with the other. The par value is an arbitrary amount. It's a meaningless number required by a specific state assigned to each share of stock when it's authorized. It has nothing to do with the market value. If someone says they bought 100 shares of a stock with a value of par value of $100, and you bought a shares of stock worth $100, but the par value was only one, it makes no difference, okay? The par value is just that, an arbitrary figure, okay? You can have no par stock in some states with stated value. Market price is the amount that each share of stock will sell for in the market. A number of years, I guess it's not that long ago, Facebook, maybe 10, 12 years ago, went public. It was Zuckerberg wanted to find, I think it's Zuckerberg's company, he wanted to cash in, okay? So he issued millions of shares to the public. The par value, I think, was a penny, but the public didn't give him a penny. He was hoping to get $50 a share. He only got 30, which only gave him like $30 billion in his pocket. The point is the market price is what the people think the stock is worth and willing to pay for it. Stockholders' equity, huh? Corporations' equity consists of paid-in capital, paid-in contributed capital, cash, and other assets received in exchange for stock. Paid-in capital, okay? Paid-in capital in excess of par is what we're going to be talking about. A company issues stock to the public. They record a line item called common stock, which is always just the multiple of the par value. That's the only thing you do with the par value. You multiply it by the outstanding shares, and that becomes the line item on your balance sheet called common stock. Any money you receive above par value, we're going to call it paid in capital. I like in excess of par. Let's review retained earnings. We should know what retained earnings are: the cumulative net income or loss not distributed as dividends. I think that's pretty clear. Your great-grandfather started a company in 1900, and the first year they had a profit of $1,000, so retained earnings became $1,000. Then they made 10,000, retained earnings went up to 11, so on for 100 years. Retained earnings is where all the net income is accumulated into your balance sheet when you close. It is reduced if you issue dividends to the public, okay? Record the issuance of corporate stock. All right, issued at par, okay. They issued 30,000 shares of $10 par value stock. Well, it just so happens that that's what the market value happened to be in this one. The public said, well, I only think it's worth $10. So they sold X amount of shares, 30,000 times 10, $300,000. Note the debit and credit. You debit cash, you credit common stock, issued 30 shares. Those are the outstanding shares of this company. But this is much more typical. Dylan Snowboards issued 30,000 shares, $10 par value, but the public valued it at 12. They forked over $12 a share. So this creates an extra complication in our journal entry. We debit cash for 12 times 3, $360,000. The par value is 10 times 30,000. That's never going to change. The par value is only used as a multiple of the outstanding shares. The difference between the 360 and the 300 is $60,000. That's an equity account called paid-in capital in excess of par value. These are equity accounts here. Issuing par value stock. Par value stock. This company, as we know, they had issued 30,000 shares at $12 a share, right? Total of 360,000. The common stock line is going to be the outstanding shares. 30,000 times 10. There's your 300. The paid-in capital in excess of par is 60. And it turns out they had prior retained earnings of 65,000. There is the total equity on your balance sheet. You have three capital accounts here, equity accounts: common stock, always the par value; paid in capital in excess of par; and retained earnings. Issuing no par value stock. Well, this can happen. Issued 1,000 shares of no par value stock. Some companies do this. Some states allow this. So you're going to debit cash and you're going to credit common stock for whatever the public valued it at. Issuing stated value stock, huh? This is much more typical. They issued 1,000 shares of stock at $40 a share. The public paid 50. You and I paid 50. So this company, Dillon Skateboards, received $50,000 in cash, $40,000, which is the outstanding shares, multiplied by the par value. Any difference is called paid in capital in excess of par. So this isn't too tough, I don't think. I think this chapter is more intuitive and easier to swallow than that of the bonds. You can issue stock for other than cash. Who knew, huh? Here we go. 4,000 shares of par value stock was issued for land valued at $105,000. So we got a piece of land and we paid $105,000 for that land, but we didn't pay it with cash. We issued 4,000 shares for $105,000 piece of land. So 4,000 shares times 20, the par value. Again, that's your common stock line. The difference is paid in capital in excess of par. Issue stock for non-cash assets again. Here we did it. We issued 600 shares of $15 par value stock for $12,000 of organizing work. Okay, we hired people to organize our offices and our computer files or whatever. And the deal is, we're not going to give you any cash. We're going to give you stock. So we have an expense that we need to record, called, in this case, organization expense. I've not heard of that one before, but 600 shares times 15, guess what? That's $9,000. Par value in excess is 3. $12,000, okay? Record transactions involving dividends, cash dividends, stock dividends, and stock splits. Hope you find this interesting. Cash dividends provide a return to investors and almost always affect the stock's market value. Now I'm thinking about that. Yeah. To pay a cash dividend, though, a company has to have cash. You have to have the money on hand. And you have to have a sufficient balance in retained earnings. Otherwise, you're really prohibited from issuing shares to the public. And the reason they're talking about the stock's market value is, I'm an old guy. I'm an old goat here. I now invest in stocks that pay a pretty good dividend, okay? I invest in stocks that pay a dividend, and I live on those dividends. If they cut the dividend, the price of that stock would tumble, and I would be kind of in a little bit of trouble there. So the amount of dividends a company pays or doesn't pay could not always affect the stock's market value. Accounting for cash dividends. 3 important dates to pound into your skull. The date of declaration. In other words, the announcement date. This is when the board of directors go into a big meeting room, close the doors, and they come out 8 hours later, and they proudly announce to the public that they're issuing dividends. A dividend is a cash payment companies can make or not make at their own behest to shareholders, okay? Think of it as money you can receive while you hold the stock. So the dividend date is, the declaration date is extremely important because that's when the liability takes place. Companies never have to pay a dividend, but once they announce it on the date of declaration, you now have to record that entry. The date of record is super important. No entry required, but the date of record is the point in time where you find out who gets the dividend. In other words, the date of declaration might say January 1st, and it says for the people who own the stock on January 14, just to pick a date. So at the end of business on the 14th, your people will print out a list of all the shareholders and the amount of shares they have. Those are the ones who get the dividend. If these people own the stock for 50 years and sold it on the 13th, they don't get the dividend. Okay? And you used to see a little bump in the price of the stock on this date because you'd have investors swoop in and buy a stock for, say, $50 a share, anticipating two things: that they'll collect the dividend, and typically there might be a little bit of spike in the price of the stock, and you might get some capital gains on that. And then, of course, the date of payment, the date you pay. So these are three real important dates. What do we do on the date of declaration? A $1 cash dividend, Z-Tech 5,000 shares. January 9th, the date of declaration, it's going to be paid on the 1st of February. That's your payment date, only to the stockholders of record on the 22nd. That's the record date. Any dividend automatically reduces your equity, and you thus debit retained earnings. That's true for a cash dividend or a stock dividend. You debit retained earnings, you credit dividends payable. That's the liability. Date of payment, very simple. You debit the liability and pay the cash, okay? But only to the people who own the stock on January 22nd. That's the strike date. Deficits in cash dividends. A deficit is created when a company incurs cumulative losses or pays dividend greater than the profits earned. They call that a deficit, huh? Here we have a company with 5,000 shares outstanding and for $50,000. But look at this. They have negative retained earnings. That means that this company had cumulative losses or paid too many dividends, reducing the stockholders' equity from 50 to 44. Let's have some fun with a stock dividend, huh? A distribution of a company's own shares to the stockholders without receiving any money. Why a stock dividend? It can be used to keep the market price of a stock affordable, and it can provide evidence of management's confidence that the company's doing well. So let's back up a minute. What is a stock dividend? You own 100 shares of IBM. 100 shares of IBM worth $50, okay? That's $5,000. And you find out that you're about to get a 100% stock dividend. That means that you no longer own 100 shares. You now own 200 shares. You own 200 shares, but the price has been cut in half. In other words, you still have the same amount of equity. Now, why do companies do this? When the stock price gets too high, psychologically, the public shuns away from it. My best example is Apple and Amazon. Apple stock, but about 15 years ago, it looked like Apple might go out of business, believe it or not. The stock was down to 5. Then it went up and up and up. And finally, it went up to like $1,800 a share, but people kind of stopped buying it. So what did Apple do, or Amazon, whichever one it was? I think it was Apple. Apple issued a 7-for-1, a 9-for-1 stock split. So instead of owning one share for 1,800, you now own 9 shares at 200, with the idea it will attract investment. Okay. There are small stock dividends, large stock dividends. 25% is the threshold. If the distribution is 25% of the previously outstanding shares or the outstanding shares, there's one handling, and there's a different handling for a large stock dividend. But let's take a look. Small stock dividend. Quest has 10,000 shares. They're going to issue a $10 per share. That's what the shares are selling for. They issue a 10% stock dividend when the market price was 15. I was incorrect. $10 is the par value. The stock price was $15. The stock will be distributed on a certain date. So here we go. The minute they announced this, remember what we said? All dividends require a debit or a reduction in equity with a debit to retained earnings. The 10,000 shares times 10, that's $100,000. The difference is called paid in capital in excess of par. It's the same entry for a cash as it would have been for a cash dividend, except we're debiting retained earnings, not cash. So I happen to, I mean, most investors love hearing about stock splits and stock dividends. You have the same amount of wealth. Your stock is still only worth, in this example, say $18, but now you have 9 shares times 2 for that 18. And hopefully it attracts investors and attracts buyers, and with a commensurate rise in the stock price. Not guaranteed, but that's part of the rationale. So that's a small stock dividend. Small stock dividend, just like a cash dividend, except you're replacing cash with retained earnings. Small stock dividend, debit retained earnings, credit common stock for the par value. Remember that common stock line is always a multiple of the par value. The difference is paid in capital. So let's look at our stock. Let's look at our stockholders' equity before and after a stock dividend. Before the dividend, they had $100,000 in outstanding shares, and they had dividend distributions of 8,000, paid in capital of 35. Okay, 143,000. They declare the dividend. Look at the journal entry, if you will. We are crediting rather, common stock dividends. They go up. We have a $10,000 dividend going up. Paid in capital went up, and offsetting that is the debit to retained earnings. So the impact at the date of declaration is 0. All we did was shuffle around the money from retained earnings to the common stock and paid in capital accounts. In other words, again, it's a reclass of your equity accounts. That's all, with no overall impact. You make the payment. Well, that affects the common stock, the dividend, and the payment. No impact. So after the dividend, you're still back to $143,000. The main difference is you no longer have $35,000 in retained earnings. You have $15,000 less, $20,000. Okay. And now a small stock distribution. I'm questioning whether this is right or not. They declare a 10%. This is actually a large. I'm going to go on a limb here. where this says recording a small stock dividend, this is actually a large stock dividend. Okay, it's 10,000 shares, 10% stock dividend. Nope, I'm going to skip this line here because these things don't make this slide doesn't make sense to your professor. Here we go. Large stock dividend. Large stock dividend. This is actually a little bit easier because it's just a 2-line journal entry. Here, they announced a 30% stock dividend. Remember, the threshold is 25. If the stock issue, the stock dividend is more than 25% of the outstanding shares, it's considered a large stock dividend. And all we need to do is debit retained earnings. Remember, any dividend at all, you debit retained earnings, large, small, stock, don't matter. Debit retained earnings, credit common stock, $30,000. These are both equity accounts, and we just learned there's no overall impact. A stock split. A stock split. Stock split. You don't do a journal entry for a stock split, okay? The only thing that happens with a stock split is that the board of directors are going to change the par value so that it multiplies out to what you have. But the impact is the same as a stock dividend. You own 100 shares of IBM again, and you find out that the stock is splitting 1-for-1. Well, you don't own 100 shares at $1 a share anymore. You now own 200 shares at 50 cents. If you received a stock split from one company and then a stock dividend from another company, you, as the shareholder, would have no idea what the difference is. It comes out exactly the same. It's just that a stock split is not an accounting function. That's a decision by the board of directors and the treasurers to change the par value, which requires a change in the corporate bylaws. Stock split, stock dividend, same impact. And I think this is a good little chart to look at here. Total assets with a cash dividend, obviously the assets go down. The liabilities, no change. Equity is going to go down because you are paying out through retained earnings. You're debiting it. Here, the paid-in capital on a stock dividend, you are going to credit common stock. Remember the small stock dividend? It was a 3-line journal entry. You debited retained earnings, you credited common stock, you credited paid-in capital. 3-line entry. Small stock dividend is a bigger journal entry. Large stock dividend, the only thing you do is debit retained earnings to decrease it and credit common stock. Okay? Stock split affects nothing. Nothing. You will have double the shares, that's all. If it was a 1-for-1 or 100% stock split. Explain the characteristics of and distribute dividends between common and preferred stock. Preferred stock, a separate class of stock, and it has certain priorities over common stock. For example, no dividends can be paid to common shareholders until the preferred stockholders get paid. If the place went out of business and they start liquidating their assets, the preferred stock would get paid before the common stock people, okay? Preferred stock is like a bond. It actually has a percentage on it, unlike a normal stock. It has a stated dividend rate, and preferred people don't vote. Preferred stock. Preferred stock. Let me talk real quick about preferred stock. This is an investment for people who are looking for a safe return of some income to them. You buy a share of stock for a preferred stock for $100, 9%. You're going to get $9 a year if they choose to pay dividends. And if they don't choose to pay you, if they're allowed to do that, they won't do it. Preferred stock doesn't share in the market success of the company. What I'm trying to say here, preferred stock is pretty much like a bond. It's just going to pay a certain amount of dividends all the time. It's never going to change. If the company makes $1 million more than expected, the preferred stock is still just going to pay that $9. The market value of the preferred stock barely moves. It moves like a bond in relation to changes in interest rates. Okay, it's preferred stock is not that I'm giving anybody investing advice, but preferred stock famous for like old guys like me to buy to get a dividend. Issuance of preferred stock. This is important. Cumulative versus non-cumulative. Cumulative. Dividends in arrears must be paid before dividends may be paid on the common stock. Non-cumulative, undeclared dividends don't have to be paid from prior years. I don't know why anybody would buy a non-cumulative preferred stock and run the risk they're not going to pay a dividend in the future, and you would lose it. Perhaps they paid more, a higher percentage. But let's talk about this. Dividends in arrears. That refers to dividends from prior years that were not paid to the preferred shareholders. The corporation needs to catch up on those shares in order, how do I want to say this? When the company's able to, they have to pay the past years to the preferred shareholders as long as it's a cumulative stock. So let's see what they're talking about here. Common stock, $10 par, 50,000, 30,000 issued, 300,000. Here's your preferred stock. This is a portion, if you will, of your stockholders' equity on the balance sheet. You have common stock, preferred stock, and paid-in capital, retained earnings. Dividend preference, huh? The corporation's outstanding stock includes 1,000 shares, $100 par, 9%, with potential dividends of $9,000 a year, right? 1,000 shares times 10, that's 10,000. That's times 100. I guess that's $100,000 times 9% equals 9,000 a year. Computed as 1,000 shares times $100 times 9%. Okay, and then you have 4,000 shares outstanding common stock. The board of directors declares a dividend of $5,000 in 2019. In 2020, the board increased the dividend to $42,000. So let's see what happened to the preferred stock people and the common stock. And this is important to understand. Well, it was a cumulative stock, so they're obliged to pay the $5,000 from 2019. They need to pay the dividend in arrear, $4,000 they're saying it is, and they need to pay the current year of $9,000. So the shareholders get a total of $13,000 or $18,000 for the 2 years. They paid the dividends from 2019, and they pay a $9,000 this year, and we get up to $18,000. Well, they only had a certain amount of money. There was nothing left over for the common stock. So the common stock people didn't get a dividend. Oh, too bad. But look what happened the next year. Here you have the dividend paid out to the preferred people, and they get 9,000 this year. Okay, so they're going to catch up on the 5,000 again in this example. 9,000 here, and it's non-cumulative. So we have $42,000 worth of cash dividends. How much of that goes each year to the preferred? 9,000. That leaves 33,000. So now the common shareholders are doing great. The common share guys, there are 4,000 shares outstanding. So they got about $9. They did almost as good as the preferred people. Plus, the common stock holders have one big advantage over the preferred stock is that is capital gains. If a company is successful and thriving, the common stock price will go up and up and up. The preferred price goes nowhere. Common stock is a long-term, more of a long-term type thing, if you want to look at it that way. Of course, the common stock people take more risk because if the company loses money, well, then the price of the stock would go down. Participating or non-participating, dividends may exceed the stated amount once common stockholders receive a dividend equal to the preferred rate, or if the dividends are limited to a maximum amount each year. The maximum is usually the stated dividend rate. Let's not get involved in participating, non-participating, okay? Dividends, participating may exceed the stated amount once common stockholders are satisfied. Let's talk again about the reasons for issuing preferred stock. You raise money without giving up control. It boosts the return earned by common stockholders through financial leverage. You don't lose control because remember, preferred shares do not vote. It can boost the return earned by common stockholders through, financial leverage. You're bringing some money in here. And preferred stock appeals to investors who may believe that the common stock is too risky or the expected return on the common stock is too low. So there might be legitimate reasons to prefer the preferred stock. Let's talk about something called treasury stock. Treasury stock. Treasury stock represents shares of a company's own stock that has been reacquired. A company buys back its own stock. That's called treasury stock. Where do they buy it from? They buy it from the open market. They buy it from you and me. There's 1 million shares outstanding and the market price is $100 a share. That's what the company has to pay. So companies, I don't want to say often, but they do buy their own stock back. And as a shareholder in Coca-Cola, they had a big treasury stock purchase, and that can be good or bad depending on the investor. And I'll babble a little bit about that as we go forward here. But why would they acquire its own stock? Well, you can use its own shares to buy other companies. You have these old shares there now. We saw before that shares can be issued for reasons other than cash to avoid a hostile takeover. Oh my goodness. You're finding out that some rich fat cats have gotten together and they're secretly buying up your shares with the intention of getting up near 50%, close to taking over the company. Well, at that point, you can go in and buy some shares and give yourself more voting power. You can buy treasury stock to give out the shares for top management as bonuses or maintain a strong market. As a shareholder, when I see my investment buying back treasury stock, I hope it's for reason number 4. I hope it's because the company is looking at their own stock and they don't understand why it's only selling at $50 a share. The company knows its own business better than anybody. And they're saying, we have a good product here. It hasn't quite clicked yet, but it will. And they say $50 a share is a steal. So they go in and buy their 1,000 shares back or whatever and hold them for a while with the hope of reselling them to the public when the stock goes up. That is a good reason for investors. But the bad reason, and I'm getting off on a little editorial, if they repurchase the shares as compensation to the big hitters, the officers of the company, that's a terrible thing. What they've done is they've just given away the company, not to the public. They have given it away to high salaried employees as bonuses, and there's no real benefit to anybody except those individual people. During the Donald Trump presidency, the Republicans passed one of the largest tax cuts in history. It was over $1 trillion. Threw another $1 trillion onto our national debt. And the argument for the tax cut was, oh, this will be great. Corporations are going to take these tremendous tax savings and they're going to expand their businesses. They're going to build new stores and factories. They're going to invest in new products. They're going to put millions of Americans to work. Didn't happen. What these companies did with that free money was they bought their own stock back and gave it to themselves as dividends. It was not a good policy. Okay, what do? We purchase treasury stock. We're buying the stock back for $11.50. I guess it was $10 a share when it was issued. Okay, so we debit treasury stock, credit cash. Notice that treasury stock is a equity account. It is a contra equity account. So when you debit treasury stock, you are reducing your equity. Treasury stock is shown as a reduction in equity on the balance sheet. How could that be? You're just saying, isn't this an asset? No, it's not an asset. Companies are not allowed to buy their own stock and record them as assets. There's all kinds of illegal shenanigans on the surface. It's a terrible conflict of interest. So when the company buys back treasury stock, they are debiting an account called treasury stock, which has a normal debit balance, which makes it a contrary account, a contra account. Okay, so they bought those shares for $11.50, and then they sold them later for $11.50. Debit cash, credit, treasury stock. They didn't make any money. They broke exactly even, okay? But this is what they were hoping for. They sold those shares, at least 400 of them, back for $12 a share. 400 shares, they received $12 or $4,800 a share. They originally bought the stock back for $11.50. So they're showing a favorable difference here of 200. Notice I didn't use the word profit. Yeah, it's a profit. They made money. But no company is allowed to report that they're making money buying and selling their own stock. It's perfectly legal for them to do it, but it affects equity, not your income statement. So this is not called net income. It is a credit or an increase in your equity. And on the other hand, you can lose money. They bought these shares for $11.50, and they had to sell them back at $10. They lost $7.50. That would too go into paid-in capital and excessive par. Explain the items reported in retained earnings. Retained earnings, remember? The total cumulative amount of reported net income less any losses and dividends declared since the company started ownership, started operating. And you could have some legal restrictions. Most states restrict the amount of treasury stock purchases. You could have loan agreements can include restrictions on paying dividends below a certain amount. So states can restrict uses of retained earnings. Prior period adjustments are corrections of material errors in past years' financial statements that result in a change in the beginning balance of retained earnings. So here they made a mistake where the cost of the land, they bought land with stock, and it turns out the land was overvalued. So the cost of land was incorrectly expensed in 2018. It's too late to do anything about it now. All we can do is impact the correct amount to get the retained earnings to, in this case, $5,400. Okay. Come on. Okay, don't play tricks with me. And let's look at this. Let's look at the statement of stockholders' equity. Beginning balance. Remember when we were doing equity statements, it was pretty simple, right? It was beginning equity plus net income minus dividends. Well, here it is in just an elongated form. All we did was add the common stock issues here. If we had any preferred here, they would be here too. So your common stock has a beginning balance, retained earnings, other, maybe that's preferred stock or something, total equity. The company made income of 48,351. That gets run through retained earnings, has no impact on the beginning balance of the stock. But look what they did during the year. They issued more shares of stock. They issued 36,531 shares, stock amount, the impact on retained earnings, and then they repurchase. Here's your treasury stock and the ending. So you have beginning plus income plus any more issues minus any purchases of treasury stock gives you the ending equity balance. Compute earnings per share. Now we'll get into a couple of metrics as we close up here. Earnings per share, one of the most widely cited accounting statistics. Earnings per share. It's your net income divided by the average. Let me say it this way. It's the net income divided by the outstanding shares. What you first have to take out any preferred dividends. The preferred dividends are going to be paid before the common people get anything. So when we say earnings per share, we're always talking common stock, okay? Net income minus an amount we have to take out, we know, to cover the preferred shares. Once we do that, we divide it by the outstanding shares, the weighted average, and we come up with earnings per share. Earnings per share. If the net income was 1 million and the outstanding shares were 200,000, that would mean that your earnings per share are $5. You as an investor can say, oh, we earned $5 a share. I hope I get some of that back in the form of an increased dividend. Or if you don't want a dividend, you hope the company plows that excess cash, that $5, into expanding or improving their product or developing new items. Earnings per share. Compute price earnings ratio. Okay, there's something totally different. Price earnings. It's simply the market value of the stock divided by the earnings of the company per share. Ratio reveals information about the stock market's expectations for a company's future growth in earnings, dividends, and possible opportunities. Market value per share divided by earnings per share. Okay. If a stock is selling for $10 and the earnings are $2, that's a price earnings ratio of 5 to 1. That's pretty darn good. Its market value is close to the earnings per share, which is a good sign. But if the market value was, say, 100 and it was trading, and the earnings per share was still $2, that is not as good a statistic, because it's trading 50 times earnings. You would have to earn that money 50 times. You would have to earn that $2 50 times to break even. Whereas with the market value 10/2, you're in sync. Compute dividend yield. One thing I don't like on these slides is they don't show this thing numerically. Compute the yield of the dividend and explain its uses. Again, these are all things investors look at before they buy stock. Dividend yield tells us the amount of cash dividends distributed to the common stockholders relative to the stock's market price. Annual cash dividend was $5. The market value of that stock was $100 per share. That's a 5% return. 5%. And you, as an investor, can say, is that acceptable to me as an investor? I don't think it is. I'm going to sell the stock. Or you say 5%. That's pretty darn good. That's pretty darn good. If I took my money to a bank, I would barely get 1%. So the dividend yield, these are all very important statistics that investors are looking at. Compute the book value. Book value, huh? This one comes up a lot when companies are being measured for their size. Computes the amount of stockholders' equity applicable to common shares on a per share basis. I'm not going to get into this in too much detail, but it's the stockholders' equity applicable to common shares divided by the number of shares outstanding. So here we take this total stock equity was 447. We're going to reduce it by anything that has to do with the preferred shares, because these statistics are exclusive to common stockholders, okay? And when we do that, we do our arithmetic, we get $33.30 per share. Book value per common share, $333,300, which we got here, after subtracting the preferred stuff, and we end up with $33.30 per common share. That's the book value. And companies are measured when you read that a certain company is the largest company in the world. You know what the largest American company is? I think they still are. Is Walmart, I believe, might still be the number one American corporation. And the way you calculate how large it is, you take the outstanding shares and you multiply them by the market price. It's called the market value, the book value, if you will. That's a measurement of the market value. And it's a real change in American business, because for years and years, the top companies were the big industrial people like General Motors, IBM, people like that. But in this world of today, it's the retailers that are the big players. End of chapter 11. Are you disappointed? We've only been doing this for what, about a full hour here, huh? Okay, I hope this is helpful to you. You all know where to find me with a text, which I don't mind getting, or an email. I might be slower on the emails. Any questions, let me know. You know where to find me for tutoring if you wish to receive some. So everybody, So anyway, so everybody take care, and hopefully I'll see somebody next week. I mean, I'd rather be before an audience here, but can't do anything about that. Bye bye.